Welcome to Capital Allocation Lab. Our mission is simple. Teach disciplined, long-term investing by translating classic ideas to clear, practical decisions for today. If you value judgment over hype, you're in the right place. Please subscribe and tab like so this lesson reaches more investors and helps us keep the content free.
So today we're doing a deep dive, really getting into the playbook for the defensive investor. Our mission here is to unpack a durable, quantitative checklist. Think of it as a set of guardrails. These define quality, they enforce price discipline, and we're going, way beyond just definitions. We want to translate each of these 7 principles into actionable steps, stuff you can actually use, maybe even this afternoon.
Exactly. And we'll test this whole framework against some, real-world scenarios. We'll talk about adaptations needed for tricky sectors like utilities, financials. And then we'll wrap it up with a complete one-page plan you can actually follow. So this deep dive, it's really tailor-made if you're choosing that second path, the more hands-on approach to defensive investing.
Let's start right there, actually. Defining that choice is crucial. The original philosophy, it lays out 2 paths for anyone looking to build wealth, but also prioritize protection.
Path 1 is, well, pretty straightforward, and it's highly effective. It's just buying a broad slice of good businesses and holding on. Today, the perfect way to do that is owning a low-cost, broadly diversified index fund. Simple. If you go this route, your main job is temperament, really. Accepting market returns, keeping costs low, and just not messing with it.
But path 2. That's for the investor who wants to get their hands dirty applying these rigorous quantitative tests, building a hand-picked list of companies, but still, crucially, avoiding speculation. You're aiming for a higher quality subset of the market, maybe higher conviction too, but it demands strict discipline. And that's who we're really talking to today, you, the listener, choosing path 2.
And the core idea behind all of this, it's protection, isn't it? Not prophecy. We're not trying to guess the next big thing, the next 100-bagger. Protection comes from, 3 things. First, the conservative price you pay. Second, the strength of the balance sheet you actually own. And third, that margin of safety, the gap between what the market hopes for and what the business is demonstrably worth right now.
Absolutely. If you start with protection, the long-term compounding tends to, sort itself out. This framework is durable precisely because it demands that conservatism at every single step.
Okay, let's dive into the heart of it then, the 7 guardrails. But it's important, like you said, they're guardrails, not straitjackets, right?
Exactly. The spirit matters more than ticking every single box rigidly. You might find a fantastic business, passes 6 tests strongly, maybe just misses one slightly. That can often be okay. But you can't just ignore the question that any single test raises. You have to address it.
Got it. So test 1, adequate size of the enterprise. This sounds like it's about avoiding the really tiny players.
It is. It's about filtering out fragility. The goal is simple. Size acts as a proxy, a stand-in for resilience. We're screening out businesses that are just too small, maybe too niche, to absorb unexpected shocks. Whether that's economic, operational, competitive, size suggests diversification, better access to capital when things get tough, and just operational depth.
So in today's terms, what does that mean practically? We're talking about skipping the microcaps, the nanocaps.
Definitely. Exclude those entirely. We're really looking for companies with, say, a multi-billion-dollar market cap. Companies showing meaningful, scaled profits, and, importantly, established, durable customer bases. We're not interested in a business where, one factory fire or losing one contract to basically put the lights out.
That's the logic, isn't it? Smaller firms, they're just inherently more vulnerable. A single product fails, a key person leaves, credit markets freeze up. The defensive investor wants resilience first and foremost. We can admire those fast growers, sure, but maybe wait until they've proven they can last. Wait till they graduate into that durability bracket.
Exactly. Avoiding those fragile early stages is really the first act of protection in this whole process.
Okay, moving on. Test 2 sounds fundamental. Sufficiently strong financial condition. This is the balance sheet test.
This is the bedrock, yeah. This is where discipline really separates defensive investing from just hoping. We require 2 core absolute metrics here. First, a current ratio of at least 2. That means current assets, cash, receivables, inventory have to be at least double the current liabilities, like accounts payable and short-term debt. It's about short-term liquidity.
Current assets twice, current liabilities.
Okay.
And the second metric.
Second, long-term debt, or LTD, must not exceed net current assets, NWA. And NWA, that's just your working capital, current assets minus current liabilities.
Right. So the long-term borrowing shouldn't be more than that cushion of working capital.
Precisely. And the principle behind this, it really needs to sink in. Never own a business that needs everything to go perfectly just to survive. Perfect economy, flawless operations. No. These rules, they were forged in tough times. Depressions, credit crunches. Back then, liquidity, not just profit, was literally the difference between surviving and going bankrupt.
So we need to ask some tough questions here. Like, could the company actually pay its short-term bills if revenue just disappeared for a year, using only what they have on hand?
That's question one. Question two, is the long-term debt low enough so that a normal spending cycle or just an inevitable downturn won't force them to issue more stock, diluting everyone just to stay afloat?
And the third one, interest coverage. You mentioned that's often overlooked.
Hugely important. Is the interest coverage, that's your operating income divided by your interest expense, is it ample? And not just in the best year, but how did it look in the worst year of the last cycle? That tells you a lot.
Let's run through that example you mentioned. A parts manufacturer. Say, current assets, $800 million. Current liabilities, $300 million.
Okay, so the current ratio is 800 divided by 300. That's 2.67. Strong pass on rule one.
The net current assets, NWA, is $800 minus 300, so $500 million.
Right. And if their long-term debt is only, say, $200 million, well, $200 million is comfortably less than the $500 million NWA. So that checks the second critical box. Pass again.
And the interest coverage. If they make $120 million in operating income and pay $15 million in interest.
That's 120 divided by 15, which is 8 times coverage. Excellent. And if we check the history, maybe the worst year saw it dip only to 4x. That confirms a really conservative, resilient capital structure. It's not just math, it's insulation against fear.
Good point. And there's a nuance about what makes up those current assets. Right?
Vital nuance, yes. You, as the defensive investor, should really prefer those current assets to be mostly cash and easily collectible receivables from good customers. If most of it is tied up in slow-moving inventory, especially stuff that might become obsolete, well, that apparent liquidity might just be an illusion. It's trapped capital.
Okay, test number 3, earning stability. This one sounds simple, but maybe quite tough.
It is simple, profound, and often, yes, painful for many companies. We require some profit, meaning no reported losses, no deficit every single year for 10 consecutive years.
10 years without a single loss.
Rough.
Wow. That must filter out a lot.
It's devastating for speculative business models. It catches the promotional types. It stops you from assuming the economy will always be perfect for this company. And critically, it often detects those accounting tricks, those mirages that look good for a few years, but then collapse the moment the industry hits a rough patch. Cycles happen. If a business can't navigate a decade without spilling red ink, it's just not defensive enough for this list.
And you mentioned a practical tip, checking the footnotes.
Yeah.
For those non-recurring charges.
Absolutely. You have to skim the 10K, the annual report. Look for those charges that keep recurring, restructurings, write-downs. If a company claims special charges every other year, guess what? They're not special. They're part of the business model. And that business fails the 10-year clean profit test, no matter how management tries to spin it.
Okay, that's clear. Test 4, dividend record. 20 years of uninterrupted dividends.
Yes, the rule is explicit. Uninterrupted dividends paid for 20 consecutive years.
Now, that's a serious hurdle today. The obvious question is, doesn't that automatically exclude most modern tech companies, the high-growth ones that reinvest everything?
The short answer is yes. And, well, it's designed to. The signal we're looking for here isn't really the yield itself, it's the habit, the management discipline. A board that has consistently paid cash through multiple recessions, multiple booms, that signals a fundamentally conservative approach to capital. More than that, it signals underlying durability of the cash flows funding those dividends, often regardless of the economy.
So different from buybacks. Buybacks can be good, but they're more optional.
Exactly. Buybacks are discretionary. They can start and stop them easily. And honestly, they're often mistimed companies buy back stock when it's already expensive. A 20-year dividend habit, that's much harder to fake. It acts as a strong proxy for an owner-focused culture and real operating resilience through full economic cycles.
But there's an exception, right? For really exceptional compounders.
There is. We have to acknowledge it. If you find a rapidly compounding, maybe asset-light business that demonstrates truly fantastic reinvestment opportunities, high returns on new capital invested, then, okay, a low payout might be acceptable. But, and this is a big but, if you waive the 20-year dividend rule, the other 6 tests have to be absolutely rock solid, especially the conservative financing and the valuation. You need extra safety there to compensate.
Makes sense. Okay, test 5, earnings growth. We need to see some growth.
We insist on modest, verifiable growth. The rule is at least a 1/3 cumulative increase over a 10-year span. So 33% growth over 10 years minimum.
We're not hunting for hypergrowth here, just proving the business isn't shrinking.
Exactly. Just maintaining and slightly increasing its earning power. And how you measure it is critical. You must use the 3-year average earnings per share, EPS, at the start of the decade, and compare that to the 3-year average EPS at the end of the decade. Using averages smooths out any single boom or bust year that could distort the real trend.
And if a company has actually shrunk over the last decade, avoid it.
For the defensive list, generally, yes. If earnings power has demonstrably declined, the discount you'd need to buy it becomes extreme. You'd essentially be betting on a massive turnaround, believing the future will be completely different from the recent past. That's a forecasting burden the defensive approach tries to avoid. We prefer businesses with at least a little bit of tailwind.
And you mentioned checking the share count. Dilution matters.
Critically important nuance. Always track the share count. You want growth that shows up per share, not just higher total earnings that get wiped out because management keeps issuing more and more stock, diluting your ownership stake.
Okay, test 6 really hits the price paid. Moderate price to earnings, PE. Price is the primary risk, you said.
It absolutely is. And here we enforce 2 valuation rules. Rule 1 is absolute. Do not pay more than 15 times the average earnings of the past 3 years.
15 times the average of the last 3 years, not just last year's earnings.
Correct. Anchoring it to verified historical reality, not projections, paying 15x gets you an earnings yield of about 6.7%. That's your starting point.
And rule 2 is relative, comparing it to bonds.
Yes, the relative rule. Using the earnings yield. That's simply earnings divided by price. You must aim for an earnings yield that's at least as high as the yield you could get on high-grade corporate bonds. Think of AA-rated bonds, for example.
Why? Because the bonds are safer.
Exactly. It's the competitive yardstick. Why would you accept less yield from a stock which carries more risk than you could get from a relatively safe corporate bond? The actionable step is crystal clear. If the stock's earnings yield is lower than the bond yield, say bonds yield 5.5% and the stock only yields 4%, you're getting paid less for taking more risk. That's just not a defensive position you have to pass.
It helps to connect PE to yield. Like 12x PE is an 8.3% yield. 15x is 6.7%.
Right, but it drops fast. 20x PE is only a 5% yield. 25x PE is down to 4%. And when interest rates are higher, like they have been sometimes, this PE hurdle becomes even tougher, automatically enforcing that price discipline.
Okay, the final test, number 7. Moderate price to assets and the blended rule. This involves price to book value.
It does. Historically, the simple limit was maybe 1.5 times book value, but the real genius here is in the blended guardrail.
The blend. Tell us about that.
This is elegant. The rule is the product of the PE ratio, remember, on 3-year average earnings, multiplied by the price to book, PB ratio, that product must stay under 22.5. So PE times PB must be less than or equal to 22.5.
PE times PB under 22.5. How does that work in practice?
It prevents you from overpaying on both dimensions, earnings power and assets simultaneously. Let's say you find a really cheap stock, PE of 12. The rule allows a PB up to 1.8 because 12 times 1.8 is 21.6, which is under 22.5. It acknowledges the assets might be working hard. Conversely, if the PEs are very low, say 9, you could justify a PB up to 2.5 because 9 times 2.5 equals 22.5. It allows flexibility based on the business model but keeps a firm overall lid on valuation.
That makes a lot of sense. It adapts.
It does. And the real power of all 7 tests working together is their humility. They don't pretend to predict the future perfectly. They just ask. Look, even if we're only roughly right about how things turn out, and even if our timing is a bit off, are we still likely to be safe?
That really captures the defensive mindset, doesn't it? Safety first.
And just to ground these rules a bit, think back historically, maybe turn of the 1970s. You could find a portfolio of big leading industrial companies trading, on average, right around 15 times earnings and 1.5 times book, basically meeting that blended limit in aggregate.
Okay, so the rules weren't impossible back then.
Not in aggregate. But here's the insight for today. When you actually dug into that portfolio, component by component, only a very small number, a handful, of those blue-chip names passed every single one of the 7 tests. The screen is designed to be highly selective. It's not meant to spit out a list of 50 okay ideas. It's meant to force quality selection and really boost the resilience of the small portfolio you end up building.
So the checklist isn't just about finding stocks. It's about disciplining the investor, making us ask better questions.
Precisely. Is that balance sheet genuinely robust, easy to love? Has that dividend habit truly spanned multiple cycles? And crucially, does the price tag quietly assume perfection? Or is there a real, quantifiable margin of safety baked into these numbers?
Now, what about those exceptions? Utilities, financials, capital-heavy cyclicals, they don't fit the standard mold perfectly.
All right, they operate under different rules, different economics. So the tests need adaptation, not abandonment. For utilities typically regulated monopolies, the standard current ratio isn't the main story. Their cash flows are more predictable but constrained. The checklist adaptation focuses on their capital structure. Their stock equity needs to be at least half of their total capital, so not too much debt relative to equity.
So ensuring they're not overly leveraged, given the regulatory oversight.
Exactly. You focus less on liquidity and more on the rate base, how much capital they're allowed to earn a return on, and how strict the regulators are. You expect steadier dividends, lower cyclicality, but regulation becomes your key risk factor.
Okay, and financials. Banks,
Yeah.
insurers, totally different balance sheets.
Completely different. Built on financial instruments, not physical inventory.
And
The current ratio is meaningless. The adaptation here centers entirely on asset quality and capital adequacy.
So for banks, we're looking at capital ratios, loan quality, reserves.
Yes. Capital ratios, asset quality metrics, reserve coverage, loan concentration risks. And valuation-wise, you'd look at price relative to tangible book value, plus a sober earnings multiple. For insurers, it's similar but different metrics. Underwriting discipline shown by the combined ratio capital levels, investment portfolio quality. The quality tests change, but the valuation discipline remains.
And those capital-heavy cyclicals, railroads, chemical companies.
The advice there is, be extra careful. Be strictly conservative. These businesses have high operating leverage, meaning small changes in revenue can cause big swings in profit. Plus, they often face significant regulatory or environmental risks. Mistakes get compounded fast in a downturn, so you should really only own these if the value is just screamingly obvious. Demand a much wider margin of safety than you would for, say, a consumer staple.
This whole framework really highlights the difference between trying to predict the future forecasting massive growth and the protective approach, which is about buying current verifiable value at a good discount.
That's the fundamental contrast. Defensive investors rely on these quantitative margins, the PE, the PB, the strong balance sheet, not on hoping their forecasts are right. And the magic really happens when you combine them all. Reasonable PE, moderate PB, demanding earnings yield compared to bonds, and that rock-solid balance sheet. It mathematically allows you to be, well, significantly less right about the future and still come out okay. That is the margin of safety.
Okay, let's make this super practical. How does someone actually implement this? What's the workflow step by step?
All right, step 1, core and sandbox. Before you even pick stocks, secure your foundation. Keep the vast majority, say at least 4/5 or 80% of your equity money in a broad, low-cost index fund. That's your core portfolio. The remaining slice, maybe up to 1/5 or 20%, that's your sandbox. That's where you apply this defensive checklist. This separation helps manage risk and, frankly, your own tinkering tendencies.
Good point. Step 2, the first big cut.
Step 2, first scream. Filter your potential universe. Look for adequate size, multi-billion market value. Look for that decade of positive net income, no losses. And, where applicable, the 20-year dividend record. This immediately gets rid of the speculative early-stage stuff.
Step 3, hit the balance sheet hard.
Step 3, balance sheet tests. Rigorously enforce that current ratio of 2 or better, and long-term debt less than or equal to net current assets. And remember the adaptations. For utilities, equity at least half of total capital. For financials, strong capital adequacy ratios, tangible equity focus.
Step 4, verify that growth minimum.
Step 4, verify growth. Calculate those 3-year average EPS figures at the start and end of the decade. Strictly look for that 1/3, that 33% cumulative growth minimum. If it's not there, the stock needs to be incredibly cheap, almost priced for liquidation to even consider.
Step 5, this is the big one, price discipline. 2 hurdles here.
Step 5, enforce price discipline. 2 ways? Yes, this is the gatekeeper. First, cap the PE at 15 times that 3-year average earnings, absolute limit. Second, simultaneously enforce the blended rule. PE times PB must be less than or equal to 22.5. And if the company is asset light, lean even harder on the next step, the earnings yield.
Which is step 6.
Step 6, compare earnings yield. Check the stock's earnings yield against the yield on high-grade corporate bonds. If the stock offers less yield for more risk, it's a pass, no matter how much you like the company.
And finally, step 7, putting it all together.
Step 7, build and diversify. Aim to find maybe 10 to 20 names across different industries that clearly pass the spirit of these tests. Don't concentrate too heavily. Equal weight them when you buy them initially. This checklist isn't about finding the one perfect stock. It's designed to build a portfolio of reasonably safe bets that work well together.
Okay, let's walk through that live example you mentioned to really nail down the math, especially that blended rule. We have a solid industrial manufacturer, passes all the quality tests.
Yep, 10 years of profit, 20-year dividend history, strong financials, current ratio 2.3, net working assets greater than long-term debt. Growth is good too. $2 average EPS 10 years ago, up to $3 average recently. That's 50% growth, well over the 33% minimum.
So quality looks good. Now the price. Current price is $36. The 3-year average EPS is $2.60.
Okay, so the PE ratio is $36 divided by $2 per cent. So it's about 13.8, let's call it 14. That passes the first hurdle, under 15.
Book value is $20 per share. So price to book is $36 divided by $20. That's 1.8.
Right. PE is roughly 14. PB is 1.8. Now for that final crucial test, the blend, multiply them. 14 times 1.8 equals 25.2.
And the limit is 22.5, so it fails.
It fails. Even though the PE looked okay on its own, the price is just a bit too high when you consider both earnings and assets together via the blend.
So what's the solution? Just forget about it.
No, the solution is patience. This is where discipline comes in. You recognize it's a good company, but the price isn't right yet, so you set a limit price and wait. Let's say you decide you'll buy it if it drops to $32. At $32, the PE becomes $32 divided by $2.60, which is about 12.3. The PB becomes $32 divided by $20, which is 1.6.
And the blend now, 12.3 times 1.6.
That comes out to about 19.7. Now it's comfortably under the 22.5 guardrail. See, patience literally creates a bigger margin of safety by enforcing a better entry price. It's a superpower.
And we do the final check, the earnings yield.
Always. At $32, the earnings yield is $2.60 divided by $32. That's about 8.1%. If high-grade corporate bonds are yielding, say, 5%, then 8.1% is much better. You've passed both the absolute price tests, PE 15, blend 22.5, and the relative test, earnings yield, bond yield.
So at $32, this company becomes a disciplined yes.
Now, understanding the checklist is one thing. Sticking to it when the market is screaming at you, that's the real challenge. Let's talk pitfalls. Pitfall number 1 is critical, stopping at a single metric.
Like just looking at a low PE and thinking it's a bargain.
Exactly. A low PE by itself can be really dangerous. If it's paired with a weak balance sheet, it's not defensive, it's probably a value trap waiting to spring. You must pair attractive valuation with fundamental strength liquidity, sensible debt levels, predictable cash flows.
Pitfall 2, messing with the definitions.
Redefining terms.
Yeah.
Don't let yourself or management invent adjusted earnings or pro forma numbers just to make a company pass that 10-year clean profit test. The power is in its simplicity. If they couldn't make a GAAP profit every year for a decade, it's too fragile for this list. Period.
Pitfall 3, denominator risk. What's that about?
That's about the book value part of price to book. You have to be careful when intangible assets, things like goodwill from acquisitions or maybe capitalized software development costs make up a huge chunk of the book value. Those assets can be hard to value, maybe impossible to sell. So if the asset base looks soft, you need to lean much more heavily on the earnings yield and the return on tangible capital rather than just taking comfort from a low PB ratio based on questionable assets.
Makes sense. Pitfall 4, giving sectors a free pass.
Sector hall pass. Yeah, thinking utilities or financials don't need rigorous testing. They need adapted tests, like we discussed, not no tests. If you can't clearly explain how you're measuring safety for that specific business model, capital ratios, regulatory stability, whatever it is you have to pass on the stock, defense requires clarity.
And the last one, pitfall 5, falling for the story.
Overconfidence in stories. This is huge. The checklist is your permanent defense against a seductive narrative. If the story sounds amazing, this company is changing the world, but the numbers, especially that blended PE and PB, don't stack up, trust the numbers every single time. Narratives change, math doesn't.
Okay, so you've built the list carefully. How do you manage it? Portfolio behavior and maintenance seems key.
Absolutely. It's not set and forget. We recommend a regular review cadence. Maybe run the 7 tests again twice a year for each holding.
And what triggers action?
Trim or exit if a company starts failing badly on balance sheet strength. Or, importantly, if the valuation just goes crazy, say the PE hits 25, or that blended ratio shoots past 30. Don't let the thought of paying taxes stop you from selling an obviously overpriced, potentially fragile stock. That kind of inertia can be way more costly than the tax bill.
What about dividends received? Just reinvest automatically.
Be prudent. Only reinvest dividends back into that same stock if it still passes the tests, especially the valuation ones. If it's currently too expensive based on the checklist, take that cash and put it into a more attractively priced name on your list, or just send it back to your core index fund holding.
And position sizing. Start equal weight.
Keep it boringly disciplined. Equal weight each name when you first buy it, and then rebalance if one position grows way too large, maybe if it becomes more than 10% of your defensive sandbox portfolio. This forces you to trim winners, sell high, and potentially add to laggards, buy low. It's built-in discipline.
You mentioned writing things down.
Simple, but vital. Write decisions down. Log why each stock passed the tests initially. And, crucially, write down what specific metric deterioration would trigger a sale before it happens. This fights hindsight bias and helps you learn from your process, not just react emotionally.
These all sound like ways to manage our own behavior. Maybe some mindset resets could help. Phrases to keep us on track.
Definitely. Here are a few to repeat to yourself. First, price is a hypothesis, cash flow is a fact. Anchor yourself to reality.
Good one. What else?
Remember the order. Strength first, valuation second, story third. Never let that sequence slip.
Crucial for managing risk.
And for portfolio thinking. Diversify because humility beats hubris. You will be wrong sometimes. Diversification protects the whole portfolio from individual mistakes.
What about when you feel impatient? When everyone else seems to be chasing growth?
Remind yourself, waiting is an action. Choosing not to buy when the price isn't right isn't passive. It's a deliberate, tactical choice to preserve capital for a better opportunity.
And maybe one more.
My favorite, because it's the ultimate truth here. Process compounds. Consistently applying a sound, disciplined process like this checklist is what yields superior results over the long haul, far more than trying to time the market or chase hot stocks.
Okay, let's really cement this, especially that blended rule with a few quick, advanced mini cases, applying the full checklist under pressure.
Sounds good. Case A, consumer staples. Qualitatively strong, clean 10-year earnings, 20-year dividend, solid balance sheet, current ratio 2.4, long-term debt equals net working assets, which is borderline but passes. Growth is good, 55% over the decade.
Okay, quality checks out. Valuation. Price is $46, a PE about 15. PB is 1.7.
Now the blend. 15 times 1.7 equals 25.5. Fails. It's over the 22.5 limit.
So even though it's a good company and the PE is right at the limit, the blend says no.
The blend says, wait, action. Set a limit price. Maybe $41 stars. At $41, the PE drops to about 13.2, PB drops to 1.5. The blend becomes 13.2 times 1.5, which is 19.8. Now it passes. Check the earnings yield, too. At $41, it's 7.5%, assuming bonds yield 5%. That's good. So $41 is a disciplined go.
Right.
The blend acted as the necessary final gatekeeper.
Okay, Case B, industrial equipment. Again, strong financials. CR 2.5, LTD well below NWA, good growth, 47%. Quality business.
Valuation check. Price is $28 in dollars. PE is around 12.7, well under 15. Book value is $14, so PB is 2.0 to 28 for too long.
Blend. 12.7 times 2.0.
That's 25.4. Fail again. Even though the PE looks good and the earnings yield's probably great, around 8%, is maybe 5.5% bonds. The PB is a bit high, maybe due to efficiency, pushing the blend over 22.5.
So here, it's the PB part driving the failure. What do you do?
Here, you need channel judgment. Acknowledge the high PB might reflect good returns on assets, but you still respect the rule. You could insist on paying less, maybe below $26, to get the blend under 22.5. Or maybe you take a smaller position size than usual because it's borderline. The checklist ensures price discipline even for attractive businesses.
Last one, Case C healthcare supplier. Excellent fundamentals. CR 2.4, LTD below NWA. Impressive 83% growth over 10 years.
Valuation. Price, $40. PE is 12.1. Looks great. PB is 2.1. The blend, 12.1 times 2.1 is about 25.4. Still too high. Fail.
This really illustrates it, doesn't it? Often the best quality companies are just priced too richly for these strict rules.
It's a common finding. The defensive investor often has to pass on popular, high-quality names because the price isn't right. Action here. Patience again. Set a limit price, maybe $33. At $33, PE drops to 10, PB to 1.73. The blend becomes 17.3. 10 by 1.73. Now it passes comfortably. The blend forces patience, acting as that critical restraint even when the PE alone looks tempting.
What about that issue of intangible assets dominating the balance sheet? How does that affect the PB and the blend?
That's an important nuance. When intangibles like goodwill are huge, the book value number becomes less reliable, less solid. In those cases, you have to rely much more heavily on the PE ratio and especially the earnings yield. Your judgment then shifts from the assets to the proof of the intangible's value. Can the company consistently demonstrate pricing power? Are customer renewal rates high? Is it consistently converting earnings into actual free cash flow? That's how you validate the worth of those intangibles.
And what about managing a stock you own that runs up massively in price, handling high valuation during maintenance?
Great question. Let's say a holding you bought correctly runs up, and now its PE is maybe 22 times its 3-year average earnings. That might push the blended PE x PV ratio way over 30. At that point, even if the fundamentals are still strong, portfolio discipline dictates you should trim the position back to its original target weight. Sell some of the appreciated shares, redeploy that cash into something that meets the buying criteria now, or back to your index core. It's about maintaining the overall defensive posture of the portfolio.
Okay, let's bring this all home. Can we synthesize this whole process into that one-page plan recap?
Absolutely. Your one-page plan needs these key elements. 1. Foundation first, that 80% or more in a broad index fund. 2. Initial screen size, 10 years profit, 20 years dividends, if applicable. 3. Balance sheet strength, CRR2, LTD equals NWA, plus adaptations for utilities financials. 4. Verify growth, that minimum 13 cumulative EPS growth over 10 years using 3-year averages. 5. Valuation caps the 3 hurdles. PE equals 15, blend PE x PB equal 22.5, and earnings yield, high-grade bond yield. 6. Diversification, aim for 10-20 names, equal weighted initially. 7. Maintenance cadence review everything twice a year. Trim exit based on failures in strength or extreme valuation. That gives you a clear, repeatable path built entirely on verifiable facts and conservative rules, not hopeful forecasts.
That's incredibly helpful. We hope this deep doc has really equipped you with a clear, repeatable way to practice defensive stock selection, hopefully without making investing feel like a stressful second job.
Yeah. The real edge from this classic checklist isn't some secret formula. It's the built-in systematic discipline it gives you. The discipline to just say no until both the quality of business and the price you're asked to pay make clear, logical, numerical sense. That naturally leads to fewer decisions, but likely better ones over time.
This is Capital Allocation Lab. Our mission is to teach disciplined long-term investing by revisiting classic ideas and applying them calmly to today's markets. Thanks for joining. If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
And let us know in the comments what quantitative concepts should we unpack next time. Want a deeper dive just on that blended guardrail? Should we walk through calculating utility rate-based math in detail? Or maybe apply this whole checklist to a specific real-world company as a case study? We're here to help translate this theory into practical action for you.
Be kind to your future self. Own strong balance sheets, pay fair prices, and try to let time do the heavy lifting. See you next time.